The ISM is where, when we get above 50 and start expanding, is where alt season is. It's where the Russell 2000 breaks out. It's where the small caps start going. It's where the riskier credit starts moving. That's the real game in town. You need a booming economy and lots of liquidity to drive the money shot. The way you can make money by just throwing a dart on your screen and whatever it hits will go up. That's to come. Those are the banana zone points when things really accelerate. It's all coming. It's a matter of patience. Don't forget, the ISM has one data point a month. And you think you're trading it with your tick charts on your screen. You are sadly deluded. That's not how this works. So hence why you just kind of do nothing and let this play out. What it suggests to me is we have catch up to do, and that goes into the end of the year. And then we'd have a period where everyone says the cycle is over, and what happens is nothing. The bears get really aggressive and it doesn't work. The bulls get miserable and start questioning their own lives and whether they fucked this whole thing up, and nothing happens. And then eventually, April, May, as ever, it explodes higher again. That's what this is telling you.
Raoul begins with a simple but critical truth. Liquidity drives everything. Whether you're looking at Bitcoin, gold, tech stocks, or credit spreads, they all respond to one thing: the amount of money and credit circulating through the system. Right now, global liquidity has been pulling back slightly, but Raoul says this is only a short-term lull. The broader business cycle, which has been sluggish, is poised to start expanding again. He points to his GMI Financial Conditions Index, a proprietary model that leads economic activity by roughly 9 months. This index, which tracks rates, the dollar, and commodity prices, has started to loosen, signaling easier financial conditions ahead. And here's the key insight. When financial conditions ease, total global liquidity follows about 6 months later. In other words, we're on the edge of a new liquidity wave.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
So liquidity has been pulling back somewhat, but we expect the business cycle to start to grow. Obviously, we've got this government shutdown. I'll come onto that in a sec. That may still kind of cause another month or two of weaker ISM because of the government sector. Maybe not. We'll have to wait and see. I'm indifferent to it because we know where it's going. And behind this indicator is probably 50 to show a lead on this. But what's important here is the GMI dominoes. And this is the liquidity cascade. Out in the future, in this lovely, attractive purple color, is the GMI Financial Conditions Index. That lives 9 months ahead of anything of the ISM. That is what leads it all. That's driven by interest rates. It's driven by commodity prices. It's driven by the dollar. And that has started weakening after a period of consolidation. So weakening here is this going up because it's inverted. So what we've got is easier financial conditions are going on. And we've seen that as rates have started to fall. So that is going on. That leads total liquidity by about 6 months. Now, there's a bit of a shifting lead lag here, but either way, we're expecting global liquidity to now follow GMI financial conditions. Does global liquidity have another down month? Probably, possibly, maybe 2 months. No, I think it's a month. And then what happens is it hooks up with financial conditions as we go into the end of the year. So October would print as a weaker month, obviously because of what is happening with the US government shutdown, where there's less liquidity being pumped in the system. But I'll come to that. And then the ISM follows suit. The ISM is where, when we get above 50 and start expanding, is where alt season is. It's where the Russell 2000 breaks out. It's where the small caps start going. It's where the riskier credit starts moving. That's the real game in town. You need a booming economy and lots of liquidity to drive the money shot. The way you can make money by just throwing a dart on your screen and whatever it hits will go up. That's to come. Those are the banana zone points when things really accelerate. It's all coming. It's a matter of patience. Don't forget, the ISM has one data point a month. And you think you're trading it with your tick charts on your screen. You are sadly deluded. That's not how this works. So hence why you just kind of do nothing and let this play out. We've got the game here. The game here is that. The game here allows the asset prices to move because total liquidity is the thing that drives Bitcoin and the NASDAQ, which are the things we really care about. Interestingly, gold actually follows, or actually is, basically current financial conditions. So financial conditions and gold are all in the future. And so when you look at gold against total liquidity, it's telling you liquidity is about to explode. And that's a really interesting thing. Gold has shifted around. Sometimes it's real rates, and other times it's other things. Other times it's just the dollar. But right now, gold's highest correlation in this kind of Bayesian world where probabilities shift and correlations shift is it's all about financial conditions. And it's basically telling us the financial conditions here are going to explode weaker. Okay, super interesting. Will it work out exactly like this? Hell no. Will it be rhyming? Hell yes. So liquidity is rising. What it suggests to me is we have catch up to do, and that goes into the end of the year. And then we'd have a period where everyone says the cycle is over, and what happens is nothing. The bears get really aggressive and it doesn't work. The bulls get miserable and start questioning their own lives and whether they fuck this whole thing up, and nothing happens. And then eventually, April, May, as ever, it explodes higher again. That's what this is telling you. I think this is probably the closest estimation in my head and what I think plays out. Let's go to April 17 to 18. There's a similar pattern here, similar kind of part in the cycle. Obviously, we think the cycle extends, but there is similarities, and we've got alligator jaws. Oh no, alligator jaws. What normally the alligator jaws will do is Bitcoin should be at about 140,000 now, but it's not. So it's diverged a bit. Oh, it's all broken, it's failed. No, I'll explain why. Because there's always reasons why things are different. Here's Bitcoin 2020 versus 2021. This seems like it's the right point in the cycle versus the previous chart, which was the final year of the cycle. This is the prior year of the cycle. And what we've got is this divergence again. I mean, look how beautifully tight that correlation is. Alligator jaws. Oh, well, it's all broken down, Raoul. This is all worthless. Spurious correlation, blah, 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 blah. Sort of. NASDAQ versus Bitcoin. NASDAQ's been doing great. I've seen all of you kind of paper-handed ninnies all going, well, I'm just going to trade tech stocks now. And what's hilarious is the amount of people from crypto have gone, well, it's gold. I'm going to buy gold instead. It's all the same trade, leads and lags. But everything divided by Bitcoin is down 99.9% over time. Just remember that when you're switching around. Tech stocks, I love. Great opportunities. NASDAQ's been stronger than Bitcoin. What gives? Aren't they supposed to be all driven by the same liquidity factor? Well, what gives is, here's the liquidity factor, global M2 and NASDAQ. I'd rather use total global liquidity, but this is a weekly chart, so it makes it easier. Basically, 97.5% of all of NASDAQ is explained by the one variable, the most powerful macro variable on Earth, liquidity. And this is a proxy for total global liquidity. In Bitcoin, it's 90%. But occasionally, look at this in the NASDAQ. Do you remember when we came out and said, you need to buy the NASDAQ, it's well overshot versus liquidity? Guess what happened? The alligator jaws shut. We saw the alligator jaws the opposite way around here. It works because it's 97% of everything that happens to the NASDAQ is the one variable. So why is this going on right now? Why is the NASDAQ diverging? Why is Bitcoin diverging from 2020? Why is it diverging here? Why is it diverging here? And the answer is, you haven't heard this from anybody yet, but I talked to you last month in the Drinks with Raoul that the thing that is happening is the Fed were tightening because the Treasury General Account was being built ahead of the government shutdown. The Treasury General Account got built. Meanwhile, the reverse repo got drained to zero. So there's one lever. If they don't use the balance sheet, there's one lever left for the Treasury and the Fed to use in driving liquidity currently. And that is the Treasury General Account. That's the checking account of the Fed. And so they've been building it up, putting some cash in the system ready for this moment. And what they then do is they will then release it by spending that money.
Shifting from macro to market structure, Raoul highlights an important technical signal. Bitcoin's Bollinger Bands are at one of their tightest points in history, the second lowest bandwidth ever recorded. Historically, such extreme compression has always led to massive upside breakouts within 9 months. He cites 3 past instances. In one case, Bitcoin rose 107% in 260 days. In another, it surged 25% in the same time frame. And during 2016, a period very similar to now, it was up 189%. Every single time, the pattern led to a major bullish move once liquidity turned positive again.
But there's an issue with spending that money. There's a government shutdown. There's nothing to spend it on. So what we've got is this period since kind of end of September, October, when, guess what, crypto started underperforming, where liquidity has stopped at the lows. And this is the lows going back several years. And that's normally driven by the Treasury General Account rebuild, and then it normally bounces back in quarter end. But we have both of those factors and it's not bounced back because there's nothing to spend the money on because the government is suspended right now. So what you get is this weird pattern where there's no liquidity because they're not using stuff like the SFR, SLR, all of these other acronyms to inject money into the banking system. They're trying to get there. The Fed is cutting rates, but cutting rates doesn't really change liquidity. It changes financial conditions somewhat, but it doesn't change liquidity. So liquidity is kind of trapped in the US. And the US is quite dominant in liquidity because the dollar is the world's reserve currency. So this period of the government shutdown means that crypto's weak. Why is NASDAQ not weak and crypto is? Well, NASDAQ's been choppy. It's basically where it was when this whole period started. But crypto's weaker because crypto's further out the risk curve. There are no earnings in crypto, really. These are very long duration assets. So they are the most susceptible to liquidity. If liquidity withdraws, they fall the most. If liquidity comes in, they rise the most. So here we are where liquidity is being withdrawn or withheld, not really withdrawn. They're not trying to do that. They have no choice. They have no way, unless they can get through stuff through Congress, to inject liquidity unless there's a mini crisis. And we've seen a bit of wobbliness in the plumbing system, but not enough for them to actually go and do something to inject liquidity. So I'm sure Scott Bessent and I'm sure the Fed are looking at this thinking, Christ, we've got no liquidity. We saw South Korea asking for unlimited swap lines. What does that say? It tells you the eurodollar market is too tight. So US liquidity, because it's still constrained by this one factor, there's no balance sheet being worked, there's no reverse repo being drained. We've got this one factor, and that's supposed to be driving all the US dollar liquidity. Well, that struggles. It struggles because it's not big enough to go all the way out to the eurodollar markets and to the South Korean banks and the European banks and the Japanese banks. So they need swap lines. So it's telling you that things are tight. And we know the answer to tightness in liquidity. It is the opposite. It is more cowbell. So as more cowbell comes in, things snap back. And that's where we are. We're at this kind of super mini version of 2019 where the Fed pivoted and everything had to change because of this liquidity issue. And this liquidity issue is what's driving stuff now. So I hope I've explained it to you. The government shutdown, yes, there's a couple of guys talking about it ending this week. The prediction markets are like mid-November. So let's think this could go on a little longer than expected. And in which case, liquidity is not coming into the system unless the Chinese really push further, or somebody else, the Europeans, the Japanese, or one of the other large economies, the Canadians or the Aussies or the Brits do something. But really, we need everybody in concert, or at least not fighting it. And the Fed are kind of drawing down liquidity. And that is the reason why we saw this. The year-on-year global liquidity is being driven by the Fed here, pulling back a bit in liquidity, not from their desire, but their constraints of having no reverse repo. And so they have to figure out how to inject liquidity because they want this number, the ISM, to go up, because the ISM going up wins them votes. And remember, next year is a voting year. When we go back to another voting year, 2016, 2018, what we got was global M2 growing nicely, and this global M2 today doing the same kind of thing. So again, contextually, everything is good. Okay, bit more interestingly, into markets itself, Bollinger Bands. Bollinger Bands kind of tell you how much volatility there is within the market. And sorry, a little snack. I do love those peanuts. And we are at the third lowest, second lowest bandwidth of Bollinger Bands in history of Bitcoin. Okay, so it's interesting. And interestingly, it reverses soon after. And interestingly, it always produces higher prices. And we pointed this out the last two times it happened. And the last two times it happened, it went up 107%, 260 days later. So whatever that is, 9 months. And it went up 125% 9 months later then, even though it had been much higher than that. And then back in 2016, which is like a similar period to now, it was up 189%, and it had been up over 200%. So the point being, these compressed Bollinger Bands, John Bollinger, I think, was on X talking about this, is like, these are an opportunity. Okay. Seasonality. We're at a really good point in the seasonality chart. And you would imagine that we are now diverging from this because of the, repeat after me, the Treasury general account and the government shutdown. Once that comes back in, we start climbing the curve to the end of the year. Does it start in November and we play catch up? Either way, we should have a back end of the year that's very strong. And in the end, you'll have forgotten all about this shit, much like we told you in April 2024, September 24, April 25. I mean, it's all the same shit. You forget about it after a while.
Raoul sees the government shutdown as a temporary pause. Prediction markets suggest it might last until mid-November, but once resolved, the Treasury will start spending again, and that's when the liquidity pulse returns. He expects the end of Q4 and early 2025 to bring a strong rebound in risk assets, especially crypto, mirroring past election year cycles. Liquidity tends to surge into election years as governments and central banks prefer smoother markets. And that's a huge tailwind for assets like Bitcoin, Ethereum, and high beta tech. Even though the short term looks uncertain, Raoul stresses that the macro structure remains entirely intact. The liquidity engine hasn't broken, it's just idling.